Hey, in this video, I'm going to show you how to create financial projections for a startup moving truck company, help you figure out how to project your revenue and your expenses, and then ultimately determine how much profit you might be able to generate depending on the number of trucks and crews that you have on the team. Before I dive into how the template works, just a little bit of my background. My name's Adam Hoeksema. I'm the co-founder of Projection Hub, and over the last decade, we've helped over 50,000 entrepreneurs create financial projections for all sorts of different industries and businesses. I also spent a decade as an SBA lender, have a good understanding of the SBA loan process, and kind of come with that experience into this work. So I wanted to mention that we have a link to this template in the description of the video below, so you can go and grab that. And also, if you stick around to the end of the video, I'm going to give you access to a coupon code that you can use to get a discount on this template as well. So with that, let's go ahead and dive in to show you how it works. So here we are on the At a Glance tab. So this is kind of the end of the process. After we have entered in all of our revenue and expense assumptions and the number of trucks that we have and the financing for those trucks and all that sort of thing, this is the end of the process. So you can see some key financial statement numbers, some key ratios, some graphs and charts that you'll be able to throw into a business plan or pitch deck for investors. We also, all of our templates have a 5-year income statement summary, a 5-year cash flow summary, a 5-year balance sheet summary, and then the income statement, cash flow, and balance sheet all broken down by month for each of the 5 years as well. So you get the monthly detail as well as the annual summary detail. But in order to produce all of these reports, we have a little bit of work to do. So I'm going to jump back now to our input assumptions tab and walk you through how to fill this out. So you can enter in your company name, the start month of your projections here. And then if you are making any personal investment, you could put in a personal investment into the business, or you could also include other outside investors here. So you could list, there's some additional slots, you could list additional investors and the value that they're investing and what month you expect them to invest. Now, we also have this accounts receivable terms assumption here. So this is assuming that you're going to get paid 100% of your revenue when you deliver the service. When you move the company or the individual, you're going to pay you upfront for that. We're assuming also that you're paying 100% of your expenses in the month you're incurring those expenses. So you're not getting any terms with vendors or suppliers. You're just paying 100% upfront. Now, on the inventory side, I've set this default to 0, expecting that most moving companies probably don't have inventory. But let's say maybe you have some boxes and tape and packing material that you would sell to your customers. So you could put, let's say you had some initial inventory, you wanted to have $5,000 worth of initial inventory on hand. And then in order to make sure that you keep some inventory on hand, you'd want to put like a small percentage in here for average inventory carried as a percentage of sales. So maybe 10% would be a good number for you. All right, so now you have the ability to add in fixed assets. So let's say you own a building or you rent a facility, you could put that in here. So you put the value in here. This is all set to 0 because the expectation is you probably don't own a building, probably just have trucks. And so maybe you have some light equipment. Maybe we could put in $10,000 for some different lift equipment and whatnot to help with certain jobs. Okay, so now the main fixed assets you're probably going to have are the moving trucks, right? And so what I have done here is I pre-filled this in, assuming that over a period of time, you're going to acquire 6 different trucks. And so we can put in the number of trucks that we're purchasing in each month here. We can select whether we're purchasing the truck or leasing the truck. So right now you'll see if I have it selected to purchase the truck, and it asks me what the purchase price is and kind of the salvage cost after the useful life of 10 years. So for salvage cost, this basically just helps us calculate depreciation of the truck. And so you could put in a small value. The idea here is what would you sell the truck for kind of once you're done with it, right? And then you can pick the month that the purchase of the truck occurred or the lease starts. And you can also set up how much of the truck purchase price is financed. So let's say the purchase price was $95,000, but we're going to get a loan for $87,500 at a 7% rate over 120 months. So a 10-year term on that. Okay, so let's say we are going to lease the truck instead of purchase. We come to this drop down here and we select lease. And what you'll notice is that it blacks out the fields, the purchase fields, because we don't need those anymore. It still has the month when the lease would start. And then instead of a loan, you would have truck payment or a lease payment. So you could put the lease payment in here. So let's say you're paying $2,500 a month for the lease payment for the truck. So that's how you could enter in leased trucks or purchased trucks. Okay, so I'm going to undo that so that we're kind of back to assuming these are all purchased. And you'll notice here that I've got the purchase month. So we're buying 2 trucks in month 1, 2 trucks in month 13, so the beginning of year 2, and 2 trucks in the beginning of year 3. So we're kind of growing our fleet of trucks here. All right, so now let's go to our input revenue tab here. And this is going to calculate the number of trucks that you have. So we start out with 2, remember? So up here we see 2, and then in month 13, we jump up to 4, and so on. And then it's going to ask you, okay, how many days are you going to be operating the business a week? So we set 5 days, Monday through Friday, maximum hours per day per truck. So how many hours could the truck be operating? We're going to say 10 hours per day. And the average hours per move, we're going to estimate at 8.5 hours. Okay, so this will then allow you to calculate, it's going to calculate the maximum hours per day, the billable hours per day that you could charge for. So it's just 10 hours times the 2 trucks. So we've got 20 hours a day. And then this will calculate, okay, how many moves could we do per month? If the average move is 8.5 hours and we're working 5 days a week, up to 10 hours a day, how many moves could we do? What's our maximum capacity? So it's 51 moves per month. And then from there, we can set our capacity. Okay, what capacity, if 51 is our capacity, what percentage of that are we actually going to do? So we're saying, okay, this projection starting in June of the year. And so maybe June is our busiest time. So, hey, we're going to start out with 91% capacity. And it's going to go down during the winter. Less people are moving. You can see in January, we're down to 23% capacity. Then we start going back up towards the summer months again. So then based on your capacity, it will estimate, okay, how many billable hours per day are you actually going to bill for, and how many billable hours per month, how many moves will you do? So these are all just calculations. From there, we're going to estimate, what are you going to charge your customers per hour for your moving service? We're saying we're going to charge $135 per hour, and that's going to include, the truck and 2 movers, 2 workers that are going to help move the items. And so we put average number of movers per job as 2. We have mover or driver pay per hour plus taxes and benefits at $22 an hour. And then we have some variable costs. So we're assuming some fuel costs per hour. So fuel cost per hour is $4.05, tires $1.35, repairs and maintenance $4.05. And these are calculations. That's why the odd numbers here. I assumed 3% of revenue. So you can see I'm taking the $135 per hour times 0.03 as our variable costs there. So 3% of revenue for fuel, 1% of revenue for tires, and so on. Okay, so once we enter in all of these expenses, variable expenses, we are going to be able to calculate our moving revenue as well as our direct labor and variable costs. So the fuel, tires, repairs, and maintenance here for moving services. And we also have a slot here for other revenue. And so let's say you are also selling, packaging materials. You could just put, let's say we're selling $1,000 a month of packing materials. So you could put 1,000 in there and grow that at some rate over time if you wanted to. So that's how that would work. And then maybe you are building the boxes out for customers too. So you could have some labor costs involved with that. So let's say we had a 15% labor cost for the boxes that we're selling plus a 20% material cost. So that helps us calculate our labor and material costs for this kind of other revenue category. Okay, and so once we've done that, now we can move on to our input other expenses tab here, and we can enter in some different expenses here. So we've got things like rent, advertising, royalties, because maybe there's a lot of moving franchises. So we're assuming maybe this is a franchise, insurance, payroll processing. You can see the different options here. But the main thing I want to point out is that you can categorize these expenses in different categories. You can also set the expense as a fixed dollar amount, meaning it'd be the same dollar amount each month, or a fixed dollar amount per truck. So for example, if you had insurance, it might be on a per truck basis. So you can see my insurance cost here, I've got selected as a per truck per month expense. So that will scale as we add more trucks, that expense will increase. And then we have other expenses that we're assuming are a percentage of total revenue. So we just assume, hey, we're going to spend 6% of our revenue a month on advertising. Our royalties, if we're a franchise, we're going to spend, X percent on those royalties. And then our last expense tab here is our salaries tab. So let's say in month 1, so we can say month started, this position, this office manager is going to start with a salary of $38,400. Benefits are going to be 10% of their salary. They've got employer taxes here. And we're going to have this office manager starting right away and going through month 60 or the end of the 5-year projection model. But let's say in year 2, so month 13 here, we're going to add a sales rep because we've got 4 trucks now and we need somebody out there giving quotes and trying to, sell. And so we have a sales rep salary here that we've added in now. Okay, so once you've done that, we are back to where we started on the At a Glance tab, and you can see the results. And so what we would recommend is to make sure that once you've done this, that your profit margins make sense with the industry averages that you can Google, and make sure that if you take a look at your cash flow statement, so if you come to this monthly cash flow statement, what you want to do is check this cash at the beginning of the period. Just make sure this never goes below 0. You don't want this to go below zero. It means you're out of cash. And so with that, I think that is everything we want to share now. I did want to just mention again that we offer a discount code on this template. And so you can go to the description of the video below, click the link to the template. There's also a link to a form down there. If you fill out the form, we'll email you a discount code that you can use at checkout as a thank you for watching to the end of the video and our appreciation for you. All right, so with that, best of luck. If you have any questions at all, reach out to us at support@projectionhub.com. Thanks.